All right. So we're at 1:01 p.m. Eastern time. So Jonathan, we'll go right ahead and jump right in.
Sure.
All right. Well, good afternoon, everybody, and welcome to our fifth JF Capital Unplugged. We took a little bit of time off since our last version of the webinar, which Jonathan was probably back in September, probably?
Sounds right.
Okay. Yeah. So since then, things have changed. Probably not as quickly as most of us on this webinar would have hoped, but things are definitely trending in the right direction. For those of you that are joining us for the first time, quickly introducing myself, my name is Nick Mellis. I'm a vice president with JF Capital Advisors. For the next hour or so, I'll have the opportunity to chat with Jonathan Falik. Jonathan is the CEO and founder of JF Capital and the guru of all things hospitality. For the next hour or so, we'll have the opportunity to hit probably about 7 or 8 topics, depending on how long-winded Mr. Falik wants to be. But we'll hit on everything from, what's going on with AirBNB and the public markets. What can we expect in terms of business travel? What will the effect be of the new administration on hospitality moving forward? And we'll also leave you with, some projections as to where we think 2021 RevPAR will be. For all of you watching the webinar, please feel free to type in your questions. You'll see a dialog box on the bottom of your screen. We'll do our best to answer each of those at the end of the presentation. We're also recording this as well, probably about 2 or 3 hours after the culmination of the webinar today. We'll send out that link and you'll be able to watch us on demand.
Or again.
Or again, right. If you're really interested in the webinar.
And Nick, the first 4 that we did were recorded and are available as well.
Right, exactly. Yes, you'll have the opportunity to take a look at those and any other questions that come up after the fact or while you are watching the recording. Please feel free to reach out to either Jonathan or to myself via email, nick@jfcap.com or jonathan@jfcap.com. Jonathan, anything to add, or you're ready to get right in?
Let's go.
All right, sounds good. So Jonathan, my first question relates to business travel coming out of the pandemic. Some in the industry, such as Mr. Bill Gates, have been very outspoken as to thinking that business travel will never come back to where it was pre-pandemic, estimating that it could be upwards of a 50% decline. Do you believe that this will be the case? And if there is any decline in business travel, where can hotel owners look to fill in that gap?
So it's really interesting, right? They always tell you follow the money. So Bill Gates, I believe, owns about 1.45% of Microsoft stock, which heavily promotes Microsoft Teams. So he has something like 40 or $50 billion worth of reason to want there to be a 50% decline in business travel.
Fair. Four seasons too, but okay.
I discount that. I discount that substantially. Will there be some drop off in the more mundane, routine business travel, heading to a monthly meeting with 5 or 7 or 10 people attending that meeting and traveling to get there? I think that will drop off somewhat, right? As the Zoom technology, as the WebEx technology, the Teams technology continues to get better and better, and as some people can better utilize their time and better manage their costs. However, when you really think through it, if people are traveling a lot less for business and they're going possibly less to call on clients, right? That doesn't speak well to the long-term relationship with clients, with partners, with colleagues, with service providers. In a lot of cases, you need to be face-to-face. And one of the reasons that a lot of people have been very successful in holding up and in completing business transactions or running their businesses during this environment is they've had 20, 25, 30 years of experience with specific clients, with specific people that they can go for a year without seeing them in person. Mm-hmm. Could they launch their careers that way and be successful with the same level of relationships? I doubt it. So what will replace, the regular business travel? A lot of it depends on work from home, right? And if there is a lot more work from home, you will end up seeing people need to travel in order to come into the office, whether it's once a week or once a month for a few days. And that will become a new class or a new segment of business travelers that we don't even have a name for yet.
Sure.
The person who sort of walked me through this in detail, probably back in April, was Ben Seidel from Real Hospitality Group. And he said, there are new segments that are coming that we don't even know what to call yet. And it's that the people that work remotely, but they need to be in the corporate office or regional headquarters a few days a month, 1 week a
Right.
month, something like that. The other thing that will happen is if more people are working from remote or working remote part of the time, they're going to travel more to go to industry conferences, conventions, and training sessions because they will crave the professional interaction, the social interaction. In some cases, they'll be looking to get out of the house
Hmm.
so their families don't strangle them, so their wives and kids or their husbands and kids don't strangle them. And they will need to do so as well for professional networking opportunities, right? If they're further out of the mainstream, if someone say used to work in Midtown Manhattan and now they live in the Berkshires, right? They're not doing the same level of professional networking they did before. So,
Sure.
we will see some reduction in more mundane, more routine business travel,
Hmm.
but I don't think that's a meaningful change in what overall occupancy will look like. I think it's just a remixing of the segmentation a little bit.
Got it. And do you think that leisure fills in some of those gaps as well?
I think leisure will fill in a lot of it. So one of the things that we've just proven, and we did so by design, is that in certain functions and certain people with discipline can work very well and very efficiently, either from home or remotely. And what that means is that in the Bravo, in the macho kind of competitive world where someone in your department used to work from home every Friday, right? You'd get snide remarks about, oh, well, they're really on vacation on Friday, even if they were up at 6 in the morning and working till 10 o'clock at night at home. And here, with the right technology, the right focus, you're going to see a greater acceptance of work remote, whether that's full-time, part-time, or certain days here and there. And what that will do is it will allow for extended weekends. It will allow for someone to go away on a Thursday, do the 3 hours of necessary conference calls, phone calls on a Friday, same thing on a Monday. So
Right.
instead of someone's weekend ending up on Sunday, you will see Sunday night in leisure markets, in resort markets and beachfront markets and leisure kind of cities or sub-markets. Sunday night is going to become much better than it used to be
Hmm.
because a lot of people will do their Monday morning group calls and meetings and then spend Monday at the beach and then fly home on Monday night or
Got it.
drive home on Monday night instead. So you will see more leisure, but what is going to be necessary is the hotels are going to have to adapt some of their offerings to accommodate that. And that might mean better use of technology to manage check-in and check-out times,
Sure.
substantially better bandwidth
Hmm.
for internet, and shared workspace. By that, I don't mean have a WeWork in every hotel, but have business facilities where a traveling business person, like just about everyone on listening on this webinar, can go and instead of going to a hotel business center and printing out 3 pages, can have access to a real printer, scanner, a private room that may be 30, 40 square feet,
Hmm.
almost like an enhanced telephone booth,
Right.
but where they can have a Polycom speakerphone, where they have a big monitor and can plug their laptop in, and they can do all the things they need to do without hearing lobby music, without hearing the blending of a mocha frappuccino at Starbucks, without the dog barking in the background or the kids crying about wanting to go to the pool. So we'll need to rethink sort of how we service those traveling business people who are away on leisure, the
Got it. Got it.
bleisure market.
Got it. Got it. Got it. Great. Next question I had was, so the onset of COVID, we've seen operating protocols change pretty dramatically throughout the country. And it's been even more so the case in large full service hotels. This has included everything from room cleanings to F&B offerings, such as, your breakfast buffet, to all the amenities that are offered to guests. Do you view any of these changes to be long term, or do you think that eventually, as the vaccine continues to roll out, we get a little bit closer to where we were on a pre-pandemic basis?
So I think there will for as many years forward as I can imagine, be a heightened sense of cleanliness, sanitization, hygiene, cleaning protocols. Will it be as rigorous as right now, 5 years from now, if there's not a COVID 2021 and COVID 2023? Everything will moderate a little bit, but there will be better, more enhanced cleaning protocols, not just in hotels, but in restaurants, in bars, in airports, on airplanes, and that's overall a good thing, right? Especially for business travelers and leisure travelers. You know, as you're going through an airport and you feel a little grimy, and you arrive at a hotel and you're tired. And the hospitality industry is actually, and restaurant industry too, has done a very good job historically of keeping things clean and keeping things safe. So it's something of a misnomer to say, well, we've now discovered, you know, sanitization and cleanliness protocols. We've had them, but now there are a bunch more that are very specific and refined, specifically related to microbes and viruses and various other kind of bad and nasty things. That will continue. You know, will we have 2 or 3 day grace periods or waiting periods between when someone checks out and someone else checks in? No. Will we have dividers and barriers, you know, a plastic or plexiglass barrier sitting between you and the next person at the bar? No. As soon as the real health fear and scare goes away, where the vaccines are fairly widely distributed, where people are not getting sick and infected on a regular basis, you'll see people sitting at bars, you know, next to each other, no problem. In certain parts of the country, you're seeing it today. You know, but you'll see it, and in some other places, we see like people literally in a bar or lounge with plexiglass, or like almost like a hockey penalty box built around them. Everyone's sitting in a little penalty box. At some point in time, they'll be out of the box. So that's not going away. Will things be wiped down a little bit more? Yeah. Will there be more focus on contactless ordering, check-in? You know, one of the things that we've seen, and the big brands have really promoted this, is on their apps, is the digital key, right? The ability to check in remotely, the same way you would with an airport, right? You know, go use the app to generate your key, use that to open your doors. Some cases use that to change the temperature in your room, you know, to interact and communicate with the hotel management. So you need less people coming to the front desk. You need less, you know, wasted time there, where usually the front desk check-in experience, unless you're in an ultra luxury resort, is fairly boring and mundane. And you should really go to the front desk only if you have an issue with your room, or, you know, you need assistance. Otherwise, you know, a regular business traveler is going to know exactly how to do it and go. So you'll see more implementation of efficient technologies. You asked about buffets. There will be buffets. You know, we Americans, especially in America, we like eating, and we like eating big, right? You know, compared to like the majority of the rest of the world, our portion sizes are larger. We have more all-you-can-eat things. Our houses are bigger, our cars are bigger, our meal sizes are bigger. Anyone who's gone and spent time in Western Europe and any of the capital cities and ordered an entree, a main course, and a restaurant, you know, and looked down and said, "What's
looking for a
this?"
second one?
You know, I wanted the entree size, and they're like, "Sir, this is the entree size." You know, that's us. Housekeeping, we've talked about this in the past. I don't see how housekeeping stays as a daily offering included in your room rate. I can see it at the luxury level. I can see certain hotels deciding to offer it as something to distinguish themselves. But the vast majority of people, especially business travelers, don't, if they're staying somewhere for 2 nights, 3 nights, one night is easy, right? They have to do a deep clean. But 2 nights or 3 nights, they don't really need someone coming in, right, to put the towel they threw on the floor, you know, away and give them a new towel. Right. At home, I don't use a towel once and throw it on the floor. I don't have daily housekeeping. You know, most of us don't. And if you think about the cost of it relative to what a customer would pay, right? So if you actually offered, here's a rate bundled with daily housekeeping, and here's a rate without, and the rate without was, somewhere between $30 and $70 less per night, right? The vast majority of people would
choosing that
say,
option.
I
Sure.
don't need it. Or you know what, if it's an a la carte service, give it to me on Thursday when I'm there.
Right.
And, again, we've talked about this before. If you're in a beachfront location, a resort location for several days with your family, and you're tracking sand in the room, you're using lots of towels because you went to the beach and the pool, and you're in the room more than you might be in an urban city center environment. Maybe there it's included, or maybe people are going to say, you know what, I'm happy to pay the extra 50 or 70 bucks a day, or $60 a day, clean the room, right? And that's an indulgence. And the only people that I think will really miss it, and be upset are the ones who maybe travel once a year, and they're very excited to have someone come in and make up the room and give them a chocolate on the pillowcase with a turn down service. They order room service because it's really exciting. The people that travel more and more regularly don't really care, and they wouldn't pay for it. They would not pay. Forget about retail value. They wouldn't pay the cost of it, right, if that was an add-on. So I think we really need to push the brands hard. We're getting away with it now, but I think industry-wide, we need to make that go away because it reduces a lot of labor cost. And, and that is the biggest cost that we have in a hotel, labor.
Right. Makes sense. The next question, Jonathan, I want to move towards the lending side of the business. From what I've seen, many hotel lenders seem to already be on their third round of forbearance agreements. It's something that I didn't really expect. I thought that lenders would have been much more aggressive up to this point. What seems to be holding them back, and what will it take for them to eventually take back the keys?
So in every meaningful down cycle, every major adverse shock, the media jumps on this bandwagon of back up the truck. We're going to buy assets at 30 cents on the dollar, 50 cents on the dollar. We're going to scoop up loans. The lenders need to get it off their balance sheets. And that hasn't happened. We're going to raise capital. We're going to put together pools of capital and create liquidity. And that has not happened, right? As an overall rule, that has not happened. In the RTC days, it took several years for the flow to really begin. Post 9/11, it took a meaningful amount of time for transactions to really happen. Post Lehman collapse and the Great Financial Recession, you just didn't see it. Now, were there individual transactions, individual portfolios or companies that had other issues, right? So in 2009 and 10, there were a whole lot of portfolios and companies that had 85%, 90% or more leverage going into the crisis. And, with that, it's very difficult to tread water and find your way out the other side. If you are 65, 70% levered and had the ability to put in a little bit more liquidity, a little bit more equity, what we saw was called extend and pretend, right? And the lenders extended, the borrowers extended, they made some minor modifications to loans, and they said, let's wait, right? There's not a lot of visibility in the market. There's liquidity out there, but there's not a lot of price discovery.
Sure.
There's not a lot of data points. In fact, if you look at the individual hotel sales market, right, it peaked in 2006, right? In 2007, there was a lot of volume related to corporate transactions, LBOs and other big portfolio transactions. The single asset hotel market peaked in 2006. It took until 2015, all the way till 2015, to get back to that same level of single asset sales and total sales volume and sales price per key. Because you went into this sort of mode for a few years where everyone was extending, everyone was asking for forbearance deferrals. Hey, extend the loan another few years, we'll put in some money. Extend the loan, we won't put in some money, but do you lenders want to control it? So the real, you started the question asking about, why so many forbearances and why are lenders being more aggressive? I can flip it around and say, well, let's think about what would happen if they were. So if lenders, whether it's mezz lenders or senior lenders, anyone in the stack starts to get very aggressive, and says, we're going to foreclose and we're going to become the equity. Well, many hotels in this country, especially in major urban markets, and especially big box hotels and certainly union hotels, are generating negative NOI.
Right.
Forget about debt service, negative NOI. So if you're the lender, do you really want to foreclose onto an asset or a portfolio with negative NOI?
Right.
And have to take on a function that isn't your normal function. The vast majority of lenders are not designed as loan-to-own capital providers. They're looking for a timely payment of interest expense and a timely repayment of their principal.
Right.
That's what they get, right? Maybe they have a participation that's unusual. The vast majority of lenders, that's what they're getting. They may be getting an exit fee, right? So they want their money back and they want to get paid for their risk.
Right.
If they turn around and foreclose, then there's all sorts of additional costs. There are transfer taxes, there's working capital they have to fund. If it's branded, they have to make good on outstanding franchise obligations. So there are a whole bunch of issues. And as any lender, and again, this is a general discussion, there are individual situations where there are ground leases, there are guarantees, there are borrowers that have refinanced and took out a meaningful amount of money well in excess of their equity. So there are all sorts of different considerations going into it, but from a lender perspective, so they foreclose, what do? If they have to turn around and sell into the open market, right, then they're going to likely find discounted valuation offered to them.
Right.
And otherwise, are they going to hold the asset or portfolio for a year, 2 years, 3 years? We don't know how long. We don't know how to underwrite.
Right.
Right. Anyone who tells you in this market environment that they can create a 3 to 5 year operating pro forma with a high level of certainty is simply wrong. There's more colorful terminology I would use if we weren't recording this, but that's just wrong. So if you're a lender, and you can hang on, right, and let the borrower, do the work, negotiate some concessions with the brand, find some other equity to infuse, that's the best outcome.
Got it.
That's generally the best outcome. It's a different story if the borrower says, I'm not putting another dollar in, right, and there are cash needs, right, the lender might need to start foreclosure proceedings.
Right.
The other thing is, while a mezzanine loan, allows for an easier foreclosure, right? It's a UCC foreclosure, and you're foreclosing not onto the real estate. So, you're stepping into the shoes of the equity versus a senior mortgage lender doing a foreclosure. In certain states, they can do a non-judicial foreclosure, but in the others where they have to do a judicial foreclosure, like New York, an unopposed foreclosure might take 18 months to 24 months, contested with lawsuits going back and forth and motions and whatever. It could take 3 years. All the while the property's suffering. So, we've seen it time and time again, cycle and cycle again, this massive, back up the truck and load up on stuff at 30, 40 cents on the dollar isn't there. Are there, and in this environment right now, it's a lot different than where we started in the end of 2008 and 2009. There was like a real crisis of confidence in the capital markets. There was a lot of illiquidity. People weren't sure which way was up, what was going on with the economy. Here, the rest of the economy is doing much better, around the hospitality industry.
Got it.
Hotels are one of the worst hit of all, hotels and restaurants and airlines, right? So travel and hospitality really hard hit. But there was an enormous amount of liquidity. There's even more liquidity available. So, anyone who thinks they're going to go pick up, a portfolio of, depressed Four Seasons, or distressed Four Seasons hotels anywhere, it's not really happening.
Right.
It's not happening. Might there be a 10% discount, 15% maybe? Just, if you can buy something and close all cash and do something quickly and relieve someone of some personal recourse guarantees, yeah, there's a greater likelihood that you can step in and get something done, but it's not a 50% discount. Anyone who's buying something at a 50% discount, right, is thinking about the valuation, probably wrong.
Right, right, right,
And
right, right.
again, that's a generalization. There are spot deals where, someone has an inside edge because they used to be the owner of the property,
Hmm,
or they used
hmm.
to be the operator, they own something next door.
Sure.
Someone who has a unique competitive advantage. Maybe they have a ROFO or a ROFR, and can step in and do something quicker because there's a high level of confidence and certainty. But
Hmm.
from an overall market perspective, most lenders do not want to be hotel owners right now.
Got it.
Uh, most of the servicers, most of the special servicers, do not want to end up being owners and being forced to ultimately liquidate the REO assets, because then they're just doing an auction, and new issue debt financing has started to come back, but is still challenging, right? You need the right type of asset and the right type of market with the right type of sponsor. And if and it's more driven by the debt funds, who with a good sponsor and good real estate and maybe long-term relationship, is willing to get paid fairly handsomely
Sure.
on the debt that they put out, and in 2 years, those loans they make today, will make them look like geniuses.
Got it. Got it. Got it. Makes sense. My next question, from a policy perspective, what effect do you think the Biden administration will have on the hospitality market as a whole? Um, Short-term, long-term impacts would be great. If you can talk through a little bit, minimum wage, access to the union, increased safety enforcement, that'd
So
be
you asked
helpful.
like seven things. If I
Yeah,
miss
yeah.
any of it,
I'll just ask him
uh,
again.
remind me,
Okay.
or tell me that I didn't pay attention. So, Biden has a history, through 50 years in public office of being very pro-union. That's he's not shy about that. No one, I don't think anyone would argue otherwise. And what he did on his first day in office was fire the general counsel of the NLRB, the National Labor Relations Board, which, to the best of my knowledge, no president has ever done that before. So there was another 11 months to serve, and it was so important to Biden to get him out, to change the messaging, and to be appreciative and thankful of a whole bunch of the union support that he had, both officially, unofficially, and through votes. And over time, literally fired on inauguration day the general counsel of the NLRB, and the following day the assistant general counsel or deputy general counsel. So he's like cleaning house at the top, and that's really important. Most people here listening to this webinar probably have not seen that written up anywhere, probably have not heard it, and it's kind of a shame that that's the case, because if any other president came in and did that, there would be articles about how there's no precedent for doing this and it's inappropriate, and they should wait for the term to be up. He didn't do anything illegal. He didn't do anything unethical or immoral. He just made a very blunt force firing decision. He didn't say you're doing anything wrong. He just said we're going to do things differently, and get out. And as a result, and also not surprising based on everything you've seen out of him through 50 years in office, and heavily backed by certain proponents within the Democrat Party, which is controlling both the House and the Senate, you're going to see an increased push for card check neutrality, all over the place. You're going to see an increase in regulation on what employers may do to try and stay union free. You're going to see a lot more latitude granted to to unions in their attempt to organize, in their attempt to bargain, and in how things are resolved at the NLRB, as well as what sort of cases are brought and what sort of guidance and enforcement actions are taken. So I don't know if people remember, but one of the things that popped up early on in the Obama administration, when the Democrats also controlled the House and the Senate, was really stepping up with this card check neutrality and getting to a place where it's very difficult for a hotel to be non-union, to stay non-union. that will, I don't know that that will be his number one priority, but it's way up there. It's way up there, and it's not going to go away. So will it take precedence over COVID relief monies? No. Will it come, and be heavily hit and heavily pushed for almost immediately after that? There aren't that many things I guarantee. I guarantee it. I guarantee it, and they'll push it, and what it ends up doing is creating substantially greater cost in operating hotel, creates a substantially larger number of union hotels, creates a whole bunch of regulation that you have to abide by and things to do, especially in this strange environment where we're in, where, if you look at PwC, HVS, Smith Travel, CBRE, no one is projecting, at least none of the projections I've seen, call for a return to 2019 RevPAR prior to 2024, right? So we have a long uphill road in terms of, both the demand recovery, the ADR recovery, and getting RevPAR just back to 2019 levels.
Right.
And in order to manage your margins, if you can't flex labor and you can't, remove certain things, or say, what, we're no longer going to run a restaurant, and we're going to lease it out, or we're going to get a third party. You can't get a third party tenant if it comes with a union labor contract. Very difficult to get a third party manager if it comes with a union labor contract, because just the wage scales tend to be high, but what really harms the profitability are very expensive benefits and very onerous work rules, where you're paying a lot more in overtime. You have to hire way more people because you can only hire into certain positions without being able to flex labor across the positions. Some markets are materially worse than others. The Philadelphia union is a lot more manageable, not simple, but a lot more manageable than New York or San Francisco.
Sure.
And kudos to the union management in San Francisco and New York. They've negotiated fantastic agreements, fantastic benefits, fantastic work rules for all of their members. But it's very difficult and very costly, and that's going to keep going. So you're going to see, you're going to see a push for higher wages, a push for more benefits, push for greater unionization. Even the thing that that is getting traction in the news now, Biden's 1.9 trillion package has a $15 minimum wage proposal and a federal minimum wage, which seems counterproductive to trying to grow back jobs and get people jobs back, where a lot of businesses can't hire at $15 an hour. And again, in New York or San Francisco or LA, it's a lot more manageable. In a lot of parts of the country, if the minimum wage is $15 an hour, right, you either have to cut hours, you have to invest in technology and automation and reduce the total number of bodies. You have to reduce service. And in a lot of cases, if your entry level person was $11 an hour, then you had some at 13 and some at 15, right, who had a few years of experience. All of a sudden, if the junior guy on the totem pole is getting $15 an hour, there's a shift that comes where everyone, is getting a higher wage, even if it's not federally mandated, because you're going to need to pay those people higher, and that ripples through, and it ends up crippling, especially small businesses. They simply just can't afford it, and until there's a technology solution where they can have, robots, bussing the tables and robots cleaning rooms, you just need to figure out a labor model where you use far fewer man hours in order to have any shot at profitability.
Right. Got it. Thank you. The next question is one that we received quite a lot of interest in pre-webinar, and that's AirBNB. So AirBNB finally IPO'd at the end of December to much fanfare and anticipation, with a valuation that eclipsed the value of Marriott, Hilton, and Expedia combined. So Jonathan, I know you've been extremely vocal about this, especially to me. But can you talk a little bit about Airbnb's business, their valuation, and how they can live alongside more traditional hospitality?
So let's back up even before we get to Airbnb, right? Back up about 20 years, about 20 years ago, and you saw the rise of what is now Expedia and Booking.com, right? And each of those companies acquired a whole bunch of smaller OTAs, and they stepped in. They stepped in and created this market disruption. Not where they took over the entire market, but they started offering, discount prices and best prices, and they were largely dismissed by the mainstream hotel industry. Like, yeah, they're not a major issue. There's some lower tier hotels that use them to fill up, but they can't really handle corporate that well, and they can't really handle group, and that's their bread and butter. That's where we get the right rate. So, they're appealing to leisure travelers. Well, the reality is that over time, you've seen Expedia and Booking.com grow and dominate. And we through our asset management business, right? And we've asset managed over time of something like 120 hotels of all shapes and sizes around the country. I like sitting down with the sales team when we first get going or do our first kind of year-end budget review and go through the sales and marketing plan. And I ask, who's your biggest customer? Who's your biggest client? Who's your biggest customer? And always the answer is, it's EY, it's Deloitte, it's JP Morgan, it's Citi. Like, no, it's Expedia. Like, I'm looking at your reports, it's Expedia. They're like, well, oh yeah, I didn't think of it that way. I said, have you ever read Expedia's financial statements? Have you ever read Booking's financial statements, right? They're public companies. Do you know their strategy? Do you know what they're doing, how they're doing it? Like, I understand that you meet with the local market manager for Expedia once a quarter, and you have a good relationship with this one and that one, but they're your biggest customer, right? And you're not treating them the same way. You're not treating them the same way that that you're treating EY and their meeting planner, right, or their corporate travel planner. So, so they came in, they took share, they took a meaningful amount of share without real loyalty programs, but by advertising. And by offering a big breadth of offerings. You can go on and you can figure out, here's the area I want to be in, here are all the options, regardless of what brand they're in. And, and I'm paying a number, and I'm not paying more than if I go straight to the hotel and book. So they gobbled up a whole lot of the revenue, really, of the ADR, that we should have in the industry, and we let them. So shame on us. Along comes Booking.com, right? That arises out of the ashes of the last downturn. And at first, everyone dismisses them, and rightfully so, based on how the company started. You can rent a beanbag in my living room. You can rent a couch in my living room. I have a spare closet, and I'll rent it to you. But it grew and grew and grew. And, and there are some firms out there that wrote research reports saying like, oh, Airbnb hasn't harmed the hotel industry. And that's just bullshit. That's bullshit. What they've done is they've stepped in, they've grown, and I'm going to address what they did in a minute that I think is brilliant. But they've stepped in and they pulled out of many of the major markets, especially urban markets, all of the compression nights. So where you used to have a substantially larger number of compression nights, right, where you're over 95% occupancy, even over 90% occupancy, and you could push your ADR higher,
right?
They pulled that away, right, by offering this shadow inventory where someone, not even just renting someone's couch, they can get a full condo with a kitchen, with a living room. They can get a 2-bedroom condo with substantially more space than in a hotel. Not necessarily all the amenities and services, but they could rent that at similar pricing to renting a hotel room. So they can have a 2-bedroom condo, in Midtown Manhattan for the same price as renting a hotel room. So they started to offer a better value proposition. And most business travelers traveling for a day or two, would book through their corporate travel program and stay at the Marriott or the Hilton, the Hyatt, an IHG or Wyndham Hotel,
Right.
whatever it is. And on leisure, it becomes way more interesting. Or corporate, if you're staying for a week, a month, on a regular basis somewhere, then it becomes a little more interesting. If you want to have really good Wi-Fi, if you want to have a kitchen with a refrigerator, if you're coming with your family and need a place for the kids, and just cramping into 1 bedroom or 2 bedrooms is kind of awkward, and paying, $25 per kid, to eat some cereal for breakfast,
Right.
is not a great value proposition. So, so Airbnb stepped in. They were not regulated the same way. In most cases, they weren't paying, hotel-related taxes. They don't have all the hotel permitting issues and licensing issues. So they expanded in a major way with an unfair playing field and advantage, and gobbled up a lot of inventory. Now, here's what they did that I think is absolutely brilliant. They turned every one of their hosts into a sales and marketing machine, right? So if you have a question, you have an issue, you're reading the reviews. Oh, so in addition to that, they have a very high level of users submit reviews, and very good reviews, right? And you can argue about their scoring system and whatnot, but they're detailed reviews because people get personalized, and partly because you as a user can ask a lot of questions about the unit, the condo, the house, whatever it is that you are renting on Airbnb,
Sure.
beforehand. And you can ask, do you have good Wi-Fi throughout? If I have T-Mobile or if I have AT&T, will I get a good signal here or there? What channels? What this? How big is a full-size refrigerator? Do you have an HDMI television? If you want to ask all those questions of a branded hotel in Midtown Manhattan, you're going to call the front desk and they won't know the answer to a bunch of it. If you say, and then if you want to travel with your family, and there might be 12 of you, 15 of you traveling kind of all together, whether it's for an event or just you're going on vacation.
Right.
And you're trying to figure out how to get 5 rooms, in the same floor, in the same area, in a hotel. You're not big enough to get the real sales department answering your questions.
Right.
So you're talking to either a front desk agent or someone in Mumbai or elsewhere who's trying to answer your questions about what's going on, versus Airbnb. You say, oh, you have a 5-bedroom house? Okay, that's interesting. And do you this? And how about parking? And how does this work? And you figure it out. So they have turned, right? They've turned the hosts into tremendous sales and marketing machines, right? At no cost to Airbnb. Whereas, Expedia can't really do that, right? I mean, they can offer up reviews. Marriott can't do that, right? Because they can't get enough people at the hotel level focused on answering all these questions within the existing cost structure and cost model. Right? It's not that Marriott's doing anything wrong. Airbnb figured out, how they can actually create a better sense of loyalty, a better sense of stickiness, a better sense of happiness, right? And put a whole lot of that sales and marketing effort onto the hosts. And good for them that they were able to do it. We should, in the hotel industry, learn something from that. Now let's turn to their profitability and valuation. Okay, so they were hyped up in a major way. There were many investment banks on the cover of their IPO prospectus. They were hyped up as a technology company. They're not a technology company, right? I mean, they have an app just like everyone else does. They have a website like everyone else does. They are not a technology company. They're an OTA. If you read through their prospectus, and they tell you who they compete with, the very first bullet point is OTAs, right? Like Expedia and Booking.com. I think the 4th or 5th bullet point is traditional hotels, right? Traditional full service, or limited service hotels is like the 4th or 5th bullet point. They don't say that they're competing with Apple or Google or whatever, and they're not, right? So there's a lot of again, I think they have a fantastic business model. They're not a technology company, and they're being valued in a way that is just asinine. It makes no sense whatsoever. So, this is not intended to give anyone any sort of trading advice. Don't trade positive or negative. Don't make any trading or investment decisions based on what I'm saying. I'm just giving you my opinion, looking objectively at all their publicly released information. And, they need, in order to justify their valuation, they need to have a stabilized $7 to $10 billion of EBITDA. And so far, based on their IPO prospectus, and we'll see their year-end 2020 numbers, their earnings call is on the 25th of February. So we'll see in 2 weeks, just over 2 weeks, where they come out for 2020. But they need to raise revenue very substantially, and they need to go from having negative EBITDA, which is where they are today, negative EBITDA. I'll say it one more time, negative EBITDA, to $8 to $10 billion a year stabilized. I've read 4 or 5 of the sell side research initiation reports where they have these astronomical price targets and they talk about it. And if you actually look at the projections that they're using, they're these incredible hockey stick projections where the revenue keeps rising, the EBITDA margins, grow incredibly, and they almost all assume that the take rate, right, the percentage of the overall revenue that they collect, right, essentially the commission rate, is going to go up, not down, which defies all logic because there's more competition and they're doing more. And Expedia and Booking and Marriott and Hilton say, hey, we can compete against them, in certain ways, maybe not against their entire business. You would expect to see that come down. The majority of research analysts are assuming that they will go into other business lines, which they have not announced, right? And don't seem to have a plan to do. I'm not sure which other business lines. And they ascribe these like astronomical, growth expectations as if they are a technology company, and that they could just keep taking and no one else is going to lose and modify their rate structure accordingly. If you put any sort of reasonable metrics on, and when I say reasonable, I'm thinking with reference to combination of Booking.com, Expedia, Marriott, and look at their forward EBITDA multiples. Put that on Airbnb's forward expected EBITDA. The company's probably worth $25 billion, maybe a little more. And just, assuming that they will magically become profitable when they get larger, without any demonstration as to how, is difficult. So then we look at, why did they IPO at 68 and finish the first day of trading at like 120 and now trading 150 or more? Well, they only sold about 10% of the shares of the company. So there was a lot of focus on pushing those shares and getting them out. There are a lot of people who are on the retail side who are Airbnb users, even on the professional side, Airbnb users, and they said, "Oh, this is great. I love it. It's wonderful. It's a disruptor. I got to be in a disruptor stock."
Right.
And they're in it. There are a lot of lockups. Right, there are a lot of the existing equity, investors, right, the private equity funds and the venture tech funds that backed Airbnb, as well as employees and the owner founders that are subject to the lockup for something like 120 days post IPO with a few other qualifications. They spell it all out in the prospectus, and when that comes, you're going to see $80 billion worth of selling pressure come into the market.
Right.
I don't see how in any rational way it can be sustained. So then people ask me, well, why does it make sense to short? And the answer is, in a purely kind of, purely in a vacuum, it absolutely does. Right. And again, this is not trading advice. It absolutely does. However, it's very difficult to short into a momentum driven market where capital flows coming in. There's a lot of liquidity out there. It's not finding a return in the debt markets. So it's pumping into the equity markets, which is pushing every equity up. And especially these, it's very difficult to short a momentum trade, right? That's not, where the company is not based on, any current sound valuation measures or
Right.
techniques, right? And this when you look at Expedia and Booking.com, right? And they're valued on an EBITDA basis. And you look at the people trying to value Airbnb and they're valued on a multiple of revenue. Like how
Right.
do you value something on a multiple of revenue? Well, you value things on a multiple of revenue, and this is what happened before the tech bubble burst, when you don't have any earnings. If you don't have earnings, you got to value on something. So they value based on revenue, it's just asinine. So I think, great for them that they did something really incredible. Yeah, the market is out there sort of, pushing this and, and promoting it. A lot of the research analysts are, and the sell side analysts certainly want to. I don't see how it ends well for anyone who, for anyone who bought in, above the IPO price. Even at the IPO price, I think it's overvalued.
Right.
But that doesn't mean it's going to trade down to those levels anytime soon.
Hmm.
That said, everyone thought WeWork was a few days away from, IPOing at something like $30 billion or so. And, and you look at it today and it's a shadow of what it was, with
Hmm.
all sorts of lawsuits around it. And, and it just proves that, a financial model and a bunch of fancy presentations doesn't create value. Cash flow does,
Got it.
EBITDA does.
Got it. Thank you. So we're running a little bit short on time. I'm looking at 1:52 Eastern. So I'm just going to fast forward to the last question. We sit here February 8th. We've heard a lot. Some people say that, 2021 tourism is going to come back with a vengeance. People want to travel. People have the money. And there are others that say, listen, the vaccine rollout has not been quite what it was supposed to be, and things will be a little bit slower to come back. Where do you fall kind of within that, Jonathan? How should people generally be thinking about 2021 in terms of RevPAR moving forward?
So Nick, you've, for better or for worse, sort of sat through a lot of this with me, through our asset management business and through I think I lose count, but I think we're working on 15 different restructuring projects right now, or restructuring engagements.
Sounds about right.
With all shapes and sizes, like large institutional hotels, smaller limited service hotels, portfolios, and so through our asset management business and the restructuring and a little bit of financing, every budget that we've seen is very weighted to the second half of the year, where there's an assumption that revenues are going to start to jump and there's going to be a lot more activity starting in June, and it really picks up in July and runs through the fall, and even greater than you would have expected in December, when oftentimes in many markets travel starts to fall and weaken, and an enormous amount of F&B revenue coming in later in the year, including sort of a full or almost full resurgence of holiday parties and year-end parties, and again, citing the pent-up demand. There is a ton of pent-up demand for leisure travel, for business travel, for group, for associations. People need it and crave it, but I don't think it's coming back as quick as as most would like for it to. That is sub-market specific. So leisure destinations, as everyone is reading a lot of the same publications, will come back the quickest. They're already doing better. There are a whole lot of corporate finance issues and capital preservation and liquidity issues that will inform corporate travel and the resurgence of group travel. And you started off on either the first or second question was, what's going to happen with the future of business travel? If you're a CFO of a company or a divisional unit head, you're going to try to figure out, okay, we laid off a bunch of people,
Right.
we're behind on orders, we're behind on profitability. Do we really need to have, a $3 million travel budget for this division? How could we do 90% of what we need to do with $1.5 million budget?
Hmm.
And how do we do it? And they start pushing, managers to justify travel for themselves or employees. And it's tough. It's tough to push travel when you've just either terminated, severed, furloughed people, when you've done hiring freezes, when you've cut people's salaries back, and then maybe, or given them no bonuses or minimal bonuses, and then telling them get on the road and go. Some people will have lingering health concerns for a while this year. So even if even if they think they're okay, they have family members. A lot of things are unclear. Unclear what happens, not even just with the travel, but how does work from home continue? Some people will want to continue to work from home, some will not. And we didn't get into this when we talked about the business travel and work from home in the beginning, but if you really think about it, everyone who is being asked, well, do you enjoy work from home? How is it? Is it good? You're getting a lot of employees saying, yeah. But at the same time, a lot of normal life is not going on. So if you were doing work from home and all of a sudden you have to take your kids to school and you have to pick them up from softball and soccer practice, and you got to take them, to the friends' birthday parties, right? And you've got to do kind of all the other things you would normally do, or someone in your household would normally do. Work from home might not be as easy as, okay, the kids are doing remote learning and, they're playing in the backyard, but otherwise they're on their video games and devices. We haven't seen how work from home works yet in large scale in a normalized, or remote work in a normalized environment.
Right.
I think we're going to move towards that trend. We will see more remote work and more work from home, but not everyone has figured out like how it works in a normalized non-COVID environment. And coming back to the question you directly asked, what does 2021 mean? I think 2021 is going to fall short for most budgets. I think things are going to be choppier. I think we, have different regulations, in different countries all over the place. It's unclear, and there's changing guidance about what you have to do to get into the country, or will have to do for an international traveler to fly in. What happens across state lines if you go somewhere and come back? When do you test? When do you quarantine? It's unclear what sort of liability employers may have if they tell their employees to travel, and only a limited number of the states have actually passed employer protection laws, which protect the employers against employee lawsuits, from traveling during this time frame, as long as they, exercised, appropriate policies and, and kind of did the right things. So there are legal impediments. There are still lingering health concerns. It looks like the rollout is far weaker than it should be. I think it's actually kind of embarrassing, the speed and efficiency of the rollout when we knew this was coming. So I think it's going to be much choppier. I'm much more optimistic for 2022 than I am for 2021, because I think by the end of the year we'll start to get there. But for business travel, and group to start to pick up in June and July, we need to quadruple the rate of vaccinations, and we need to pass various liability reform, and we need to figure out what else is happening in the marketplace with inflation, with with cost of labor, with labor terms, et cetera.
There's a lot to figure out. Thank you. So with that, right on time, so we're at 1:59. Do you want to take a few other questions, Jonathan?
Yes, but not the first one.
That's fair. Yeah, I was going to move through.
And I'll just, I say that in jest. The first one came from one of our near and dear friends who asked right away when we started, where did you both get your haircuts? So you will have to join JF Capital Unplugged 6 in about a month to find that out.
That's it. It'll be my first question.
Okay.
All right.
The second one also is kind of a polite way of insulting me, so we can skip that.
I think you got to go down to 4. Yeah.
Okay. Read out, and I'll try to address quickly.
Could you please comment on the ability for lodging investors to bridge the gap with continued forbearance versus significant pressure or need to mark to market for many lenders and owners?
Okay, so there are several things in there, but so far the bank lenders have gotten a real pass from the regulators. in terms of, in terms of regulatory capital requirements and ability to clean their books. My guess is they will probably still have a pass in 2021, and it won't be till 2022 when the regulators start to tell them if you really have bad loans or impaired loans on your books, you better get them off. The PPP loans were a nice help, but the first round at 2.5 times your previous monthly payroll, just a Band-Aid, right? I mean, that helps you for a few months on your payroll. And same thing with the second one, 3.5 times for PPP round 2. That's okay. Forbearance is helping. A lot of the bank lenders have been encouraged to forbear. The insurance regulators, I don't think have provided that same real relief, but I think they've also not been intentionally cracking down. And then when you get to debt funds and the like, and hedge funds and whatever making loans, they're doing whatever they think makes most sense. So you're going to see more forbearance, especially where the borrower is able to infuse some equity to cover operating shortfalls. When we, and I think that'll continue to go on for the better part of the next, 12 to 18 months.
Next question. If we were to reduce housekeeping offering on an ongoing basis, what does that mean for the recovery of ADR? Wouldn't that lower the ADR?
It might lower ADR some, right? If people really believe that they're getting that huge benefit, but if you reduced your ADR by $20 per night, but saved $35 in housekeeping costs, I like that trade all day long, and I would do that. So yes, you might get to a lower ADR, but a higher profit.
Got it. Next question with regard to lenders and their ability to kind of take back the keys and their willingness to. Can you address CMBS versus balance sheet lenders?
So a balance sheet lender has the ability to turn around and recut the loan, to sell the asset off after they've taken a deed in lieu or after they've foreclosed. They can sell it off subject to some new seller financing. Once a CMBS securitization trust is taking back the keys or completing a foreclosure, they're selling the REO asset. So they're selling it without the benefit of debt financing in place, which means any buyer has to go find their own. And even though the debt markets are starting to reemerge, they're not attractive and they're not available equally to all borrowers and all sponsors.
Got it. What are your thoughts on CH11 approach to restructuring?
I don't know what that is.
I don't either.
Oh, Chapter 11.
Oh, Chapter 11.
Chapter
yeah.
11.
Oh, there you go.
Okay, got it. It's Chapter 11 is extremely expensive. So you actually need a fair amount of money to be able to fund a bankruptcy filing and process. There are a ton of filings. There are a ton of lawyers involved. There are a ton of unintended consequences. It will make sense in some cases, but it's very difficult for a smaller portfolio, to do a Chapter 11 filing because it's so cumbersome and it's so specific and technical. They may have to do it, and they may be successful at the end of the day, but there are many unintended consequences that come with that.
Do you think a large property like the Marriott Marquis here in New York can realistically remain non-union?
So my understanding on the Marriott Marquis, and I could be wrong, my understanding was that they had a carve out, right, and an agreement where there were other Marriott properties at the time that would be unionized, or would go through a union election process, and they would not. In terms of, most big box hotels and heavy union markets, the vast majority of them are union hotels, and there's a very specific reason for that, right? If you're a union organizer, you're going to go where the jobs are, right? So the bigger hotels have more employees and more jobs, and and way more people that can start an organizing campaign, way more people that might be unhappy with the current situation. But you're going to see, you'll always see in a heavy union market, the majority of the large big box full service hotels union. The real question is what will happen, in this administration, in this Congress, with card check neutrality provisions and micro unit organizing and all sorts of things that make it much easier for unions to organize. Well, you see union organizing activity in traditionally non-union states, right? I give an example like Texas. I think there are only 2 union hotels in the state of Texas. One is owned by, either the city of Houston or an affiliate, and the other was heavily subsidized by the city of Houston or an affiliate. And they're both downtown by the convention center, and they're both, over 1,000 rooms, with a lot of meeting space and a lot of other ancillary stuff. And that's what's union in Texas.
I think maybe we could do one more. So
One more.
what would you say the impact to valuation is for a property that is unionized versus non-union?
It's impossible to answer that because a union contract in New York City is a lot more onerous, and a lot more costly than one might be in, somewhere in Florida. So it's a function of the contract, and it's a function of who's in the bargaining unit, and also a function of who in the competitive set is union versus non-union. So how are you competing against others, both in terms of certain types of group business, right? Whether it's association or state business that wants to sometimes patronize union hotels. So there's no way to answer that without getting into the specifics. In some cases, it's, way more dilutive to value than in others. And it really depends on the nature of the bargaining unit and the nature of the contract itself. We've, as you're painfully aware, Nick, we've dug into this in a number of different jurisdictions.
Quite a few.
Evaluating exactly that, as well as the impact on property tax valuations, right? Totally separate from regular valuations, and that's something that the tax appraisers are not really plugged into and don't really understand. And oftentimes, and again, as you're painfully aware, we've educated them a number of times in a polite and professional way, but there's significant valuation implications for the vast majority of union contracts. Even if you think it's a harmless contract, there are certain investors that will not buy a union operated property. There are certain managers that will not manage them. There are certain lenders that will not lend to them. So, and then in addition to the obvious, what's the cash flow? There are all sorts of other issues on an ultimate sale or a shutdown, as we've seen in New York with this massive severance exposure, and with what will likely be going forward, a lot of unfunded or underfunded pension obligations that if someone is selling and withdrawing from a multi-employer plan, they're going to get hit with massive additional obligations that don't show up on their balance sheet anywhere. They're not on the balance sheet today.
Right. Understood. Okay. So we're coming up on about 10 minutes past the hour. So I want to thank you for your time. Really appreciate all of the answers. Hopefully everyone on this webinar enjoyed it just as much as I did. We will have a recording coming out within the next probably 2 hours or so. So look out for that, and really appreciate everyone's time. Any other follow-up questions, please feel free to reach out to either Jonathan or myself. Thank you very much.
Thanks, Nick. And I'll do one quick final plug. Right, we're in the middle of a lot of restructurings, which seems to be the nature of what everyone's doing today. We're actively involved in asset management and complex structuring, some litigation support, and our new division that we didn't talk about today, JF Social, which does social media for hotels that we asset manage, as well as others out there. And we've taken over a bunch of hotels, restaurants, catering venue facilities, some businesses. We've been applying our hotel discipline and our accounting and financial discipline to the social media landscape, and it's proven very successful. So thank you everyone for listening. Hope to see you. I wish we could, see you at the next conference, the next dinner, luncheon, et cetera, soon. And until then, we'll look forward to the days that we can. Thank you for listening. We appreciate all of you.
Thank you, everybody.